What we're looking at right now is the historical chart of the most beloved monthly paying dividend real estate investment trust, Realty Income, which, as you can see, has been nothing to tout about as of late, as it's down by roughly 6.3% over the last 6 months, down by over 11% year to date, and down by a pitiful 8.52% over the last handful of years. Yet I'm here to say I'm not only a major fan of Realty Income, but I'm still buying. So today, I want to go ahead and share why the heck I'd be doing so, all while the stock has shown nothing but lackluster performance all year long. With that, let's dive right in. Now, it really shouldn't take a rocket scientist to raise a red flag or two when it comes to Realty Income right now, as it's trading for $56 per share, and all throughout the year, it's really only plummeted to some lower lows that we haven't seen as investors since 2020, which had plenty of shareholders up in arms, especially when it hit a rock bottom low of $46 per share. Now, certainly, all investors should raise concerns when stocks in their portfolios perform so pitifully. However, concerns, worries, and fears should not lead to an investor panic selling or running in the opposite direction of what very well could be a once-in-a-lifetime beautiful buying opportunity. And in this case, that is exactly how I feel about Realty Income. Now, in order to even understand why Realty Income should be on every dividend investor's watch list as a buy as opposed to, say, a hold, or for those of you who really can't stomach the market volatility, a sell, we need to first come to understand Realty Income in and of itself as a business, and then familiarize ourselves, at least on a macro level, with the macro environment, which has played a significant role in spooking away the masses of investors from such a golden nugget dividend stock opportunity. Then, and only then, can we really get into what Realty Income's future very well may look like, and perhaps may come much sooner than we all think. So first, the Realty Income business model. As we all know, Realty Income is a real estate investment trust, which means they're in the business of owning, operating, and financing income-producing properties. And of course, as we, the shareholders, invest our money into such money-printing machines, we then get to act as landlords and collect rent on a monthly or quarterly basis through dividend distributions. Such an investment model is arguably better than owning a physical real estate portfolio of our own, because we really don't have to worry about doing all the heavy lifting or the burdensome work of an actual landlord. But when it comes to Realty Income specifically, it isn't just your run-of-the-mill real estate investment trust. You see, it was founded all the way back in 1969, which means the Realty Income team has really navigated through plenty of market swings during that time and has only perfected their operations to ultimately achieve what we now all see today: a REIT that has over 13,200 properties within its portfolio, with over 1,300 clients, or tenants rather, to fill them. Now, Realty Income's safety guarantee really lies within that above average 98% occupancy rating that they maintain thanks to their clients that range from Walmart and Home Depot to the smaller but very prominent corner store chains like 7-Eleven, Walgreens, and CVS. And as the company has expanded into every single U.S. state, they have now, over the last handful of years, really begun to expand more aggressively outside the United States into Spain and the United Kingdom. So now overall, we have a very well diversified and fortified real estate investment trust on our hands. But as we all know, we should never judge a book by its cover. I mean, after all, Enron looked like a golden nugget opportunity as well, and that stock only was pumped up to be fool's gold.
Can add a gazillion dollars to the bottom line.
All right, that sounds fantastic.
However, in Realty Income's case, it's very much so a different story, and we can see that so when we pop open their balance sheet for a quick glance here at a very high level to see some important metrics, like their assets that come in at nearly $50 billion versus their liabilities, or debts rather, that amount to only $20.8 billion, making for a difference of $28.84 billion. Now, in other words, should all things hit the fan in Realty Income, or all of us find ourselves in the muck of more market turmoil, Realty Income is very likely to just continue to withstand all of the market volatility, which now leads me to our macros and why, when it comes to an investment in Realty Income, you should really understand those macros. You see, not long ago, Jerome Powell and the Federal Reserve gang made the decision to cut interest rates to next to near zero and leave them there for an extended amount of time, all to spur the economy following the mayhem of 2020. Now, let me tell you, businesses across industries went on a major spending spree, Realty Income and its real estate peers leading the charge just after tech giants, as they could get really steals of deals out there because they didn't have to worry all too much about paying interest. Now, it was a period of really making it rain for those who played their cards right, as the Federal Reserve now began to raise interest rates back up and, of course, keep those rates elevated for now a prolonged period of time. We have a lot of investors who are spooked away from the real estate sector because they were terrified of defaults. Now, that is understandable, but what happened was a mass exodus of shareholders from stocks like Realty Income, a company that we just said was a dominant industry leader and a real estate fortress. Of course, moves like Realty Income's casino expansion added some worries for shareholders, and the Spirit Realty acquisition, but both of which I think are in Realty Income's wheelhouse, and even Simply Safe Dividends noted here that the company likely remains very safe and in good standing condition. So then where do we really go from here? And what's the future look like? Well, if you ask the analysts, they see upside coming up to $59.42 in the near term. That's just over 5% worth of upside. And then if you check in with smart money, a ton of hedge funds have already been buying back into Realty Income with over 248,000 shares purchased last quarter when the stock was actually trading at lower lows. But now if you ask me, I say that if you're a longer term investor and you're investing into quality companies, because in Realty Income's case, we see over 142% worth of appreciation over the last decade. And while I get it, past performance certainly doesn't drive future growth, I think we can expect continued growth from Realty Income, and perhaps at a slower rate, but growth nonetheless. As we pop into Simply Safe Dividends here to see a low beta coming in at 0.71 with a slower dividend growth rate as well, yet with a safe rating of an 80 according to their scoring system, all while enjoying a nice 5.45% dividend yield. And we could get even more growth from that dividend, as it's averaged about 5% worth of dividend growth over the last 20 years with an uninterrupted dividend streak without a single reduction for over 54 years. Now, investors, let me know your thoughts on Realty Income in a comment down below. Find more dividend stock ideas right here in this video, but before you actually click away, make sure you're subscribed so you never miss a single dividend stock idea.